So there's signs, if you look for them, that the credit markets are not healthy and they're potentially deteriorating. And that's something I would pay very close attention to too, because if business development companies are starting to write down stuff, we're starting to see more cockroaches, as Jamie Dimon recently said we might. Then that plays into this theme of earnings disappointments and kind of a turn in the cycle. Rising unemployment, as we talked about, could be bad for the passive bid. I think all of those things paint a pretty nasty potential picture for stock prices this year.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has been warning for a good while now that the current bull market in stocks is approaching its end. In no small part because corporate insiders, who know the most about their company's prospects, are selling their shares at record levels. It's not all gloom for investors, though. He also predicts that commodities and the stocks of the companies that produce them are set to experience a boom. For a full update on his outlook, we welcome back to the program macro analyst Jesse Felder, founder and editor of the Felder Report. Jesse, thanks so much for joining us today.
Hey, good to be back with you, Adam. Thanks for having me.
Hey, it's always a pleasure, Jesse. Thank you so much. Glad to hear that you are skipping out on the frigid weather that much of the rest of the country is having. You told me it's going to be almost 80 where you are today, so I'm sure we get a lot of jealous viewers here.
Yeah, well, it's a blessing to be able to be down here this time of year, and I feel for everybody around the country. It's why part of the reason I moved out of Central Oregon was the winters were a little too harsh.
Yeah, and that's in Oregon, right?
Yeah.
It's getting everybody. Florida here has been, freezing down in the 40s. New York, I just saw this morning, was 9 degrees in Manhattan, but felt like -7. My little brother lives in Wisconsin, and a few days ago there, it was like -20, but feels like -35. I mean, those are just ungodly temperatures.
Yeah, I was watching the outdoor, NHL hockey game they had yesterday in Tampa Bay, and thought, how can they do an outdoor hockey game in Florida? But the guys, were huffing and puffing. You could see their breath and stuff. So, hey, it was a pretty cool experience to watch down there.
All right. Well, sometimes novelty is nice, but I'm sure most of the country is saying, okay, let's wrap this up pretty quick.
Right.
All right. Well, look, speaking of wrapping things up, let me wrap up the intro and just get straight to the stake here. You and I are recording this on Monday morning, February 2nd, Groundhog Day. By the way, I don't know if this is a sign for the markets as well, but Punxsutawney Phil, the groundhog, did see his shadow. So those folks suffering through winter right now might have 6 more weeks of it to deal with as normal. But on this day, it is the first day of trading since, we'll call it Silvermageddon on Friday. But I mean, it wasn't just silver. All the markets have been getting kind of beaten up, but I mean, the precious metals have just been getting eviscerated. So let me just start by asking you a very simple question, Jesse. What the heck just happened?
Yeah. Well, I've been bullish on the precious metals for the past 10 years, really. 2015, I started writing about how down and out the metals had become, sentiment had become. I think I even referenced at the time a Meb Faber piece that showed when any asset class or sector is down 3 years in a row, subsequent returns are really good. And metals, that was around the time the Wall Street Journal called gold a pet rock, and obviously the last 10 years have been really good for gold bulls. I think generally, we're still in an environment where it's friendlier to real assets than to financial assets. We can dig into that. But I think over the past year, really, there was a speculative momentum trade that kind of came into the precious metals. Bloomberg has reported today about how much leverage buying there was among Chinese, kind of retail investors. And whenever you see that type of parabolic advance, it always kind of ends the same way. It's impossible to time. Although, we were talking about our mutual friend David Hay, who did a phenomenal job of timing it last week. I think he sent out a thing on Thursday saying, it's probably time to to be cautious towards the metals here, and that was right before they reversed. So, yeah, for everyone else besides Dave, it's really difficult to time these things. But they always kind of work the same way. Whenever you get that parabolic blow off, you get the kind of action that we saw on Friday, and probably should continue for a while just because you need some deleveraging. There's been so much, call option buying and leveraged buying of, the ETFs and things, that it just went a little bit too far to the upside. I still think we're in a structural bull market for real assets that will last another at least 5 years. But, another thing that I've been talking about for the past 12 months is that relative to gold, the rest of the commodity space looks really, really cheap. And that's actually one of the best ways, I think, for if you are a structural bull on the commodities space, to look at them, price them relative to each other. And when you look at oil relative to silver, you look at the oil price relative to gold, it suggests that, the energy component within commodities had become unduly cheap, and the precious metals relative to the commodity space had kind of gotten overdone. That said, I will say that I think the precious metals typically lead these types of commodity bull markets. And so this huge move by the metals is kind of foreshadowing, and we've seen it, the rest of the commodity space starting to play catch up. The Bloomberg Commodities Index has kind of broken out recently and been really strong. But I think the next leg is probably likely to migrate more towards energy and oil specifically.
All right, like a great interview guest, Jesse, you are interpreting many of the questions that I have here. So I want to dig into a lot of these with you, but just getting back to the end of last week's actions really quickly. Like I said, it wasn't just the precious metals. It was the markets themselves were weak across the board. And the question I want to ask you is I guess two things can be true at the same time. When these vertical moves happen, as you say, nobody can time when they're going to reverse. Did we just hit the magical moment where sellers outnumbered buyers? Or the narrative that was playing all weekend was, well, it's because Trump surprised everybody by nominating Kevin Warsh, who's thought to be more hawkish, and therefore that's bad for all assets because he's not going to want to lower interest rates as much, and precious metals being an inflation hedge, that's particularly bad for precious metals. So how much of it was due to Warsh versus how much of it was just due to, well, when things get overbought at some point, they correct?
Yeah, it's funny. My son, 26 years old, just got out of the Air Force recently. He's in college, and he called me this weekend to ask me about gold and why gold. Obviously he and his friends are paying attention to it, which is, whenever he was asking me about cryptocurrencies a couple of years ago and Dogecoin and stuff. And so when I know what they're paying attention to, I know probably it's gotten a little too much attention.
Is so your
he was saying, is it true?
Boy indicator?
Yeah, exactly. Is it true there was this big gold discovery in China and that's why the price crashed? And I kind of explained to him that I think what happens is a lot of times prices move and then people look for a reason, right? And a lot of time the reason is you saw way too much speculative interest, for a period of time. The call option buying in GLD, SLV was off the charts. The volume in those ETFs was off the charts. Literally, SLV became one of the most heavily traded vehicles on the planet last week, like bigger than QQQ, bigger than any of the most popular ETFs.
That's crazy. Sorry to interrupt, only because 2 years ago, we could have, paid every American to go buy, and we still couldn't have gotten that much interest in SLV. Nobody cared. Yeah.
Yeah. And that's how I feel like 99% of the time when I'm talking to you, Adam. I'm always talking about stuff that people, probably hear me and say, man, this guy's an idiot. But I mean, a couple of years ago, I was talking about precious metals and how gold was, one of the main things to own. And but when it gets that overbought, you can't even really look at overbought indicators, but it's really more about the retail influence. And I'll say that you're absolutely right to point that out, that is a broader condition. It's not just in the precious metals. I wrote a market comment this weekend to my subscribers about how the fact I've recently started reading Andrew Ross Sorkin's 1929. And one of the things that turned Jesse Livermore, bearish in 29 to where he profited from the crash was the New York Times reporting that, retail investors had become the new smart money in the market. That, everyday mom and pop investors had been the ones to make all the money in 1929, while, institutional investors had become too cautious and they were now the dumb money. And if you look around, at any of these financial publications today, even the New York Times, they're all saying the same thing, that it's retail investors buying the dip that are making all the money and that are now the new smart money, right? They've rescued the market from the panic selling from Liberation Day. They rescued the market from the COVID crash, just piling in and buying the dip. And I think there's this idea similar to what we saw in 1929, that there's a new speculative era and that this is a persistent phenomenon that will last indefinitely into the future. And I think that's where people are making a mistake, is that this type of retail involvement is always a sign of overheated markets. It's never a sign that, even though people want to believe that, markets have evolved and it's opened the door to wealth creation for the masses. And that is actually when people start believing that, and you start seeing the major news outlets. I mean, every single one of them over the last 6 months, Bloomberg, CNBC, the Wall Street Journal, they've all published pieces to the effect that retail investors are now the smart money, and institutional investors have suffered because they haven't been as aggressive as retail investors. And I think that's a sign that there's significant overheating and speculative euphoria across a number of asset classes. And the growing volatility that we're seeing in precious metals is potentially a warning sign that a lot of times margin calls in one asset class can start to affect, you get a cascading effect across other asset classes. And so I would just say the rising volatility is not a great sign for asset prices generally, for risk assets.
Okay. Yeah, and volatility has largely been very constrained too. So it's sort of a sleeping monster that people tend to forget about, or a sleeping dragon. So it's interesting, Jesse. So you combined a couple of things. There's the saying, if you don't know who the patsy is at the poker table, then it's likely you. And, generally people say by the time the retail shows up to the trade, that's the patsy sitting down at the table. And kind of historically that has been true, right? When retail piles in and it's into a late stage mania, that usually is the sign it's about to end. Right. You also talked about this presumption that it's now different, right? And going back to 1929, back then, they were saying, well, it's what is it, a permanent plateau? The market is now on this
Irving Fisher, exactly, yeah.
Yeah. And of course it wasn't, right? So you combine those two things, and it's like, yeah, it's doubly we should be cautious here, because history has shown us that this generally doesn't end well. What is kind of interesting is there is an argument for more persistent retail participation now, and that's Mike Green's passive bid, right? The giant mindless robot of these passive purchases that are made every month through retirement programs and things like that. And I think he has proven, through white papers and study that it's a real factor. It's a real factor in what's going on. And I wonder if that gives people who are making those comments about, well, it is different this time and retail saving everything, because to a certain extent that passive bid is really contributing to that, right? It's sort of, retail tied money, because it's tied to workers, that is there supporting prices. And so that, there's a sense of not so much of a pal put anymore, but of a passive put to the market. Yeah. And people, I think, are assuming too that that's just going to continue forever, and it very well may not.
Yeah, I think it's a very valid point, and I'm a fan of Mike's work when it comes to the passive stuff. I think he's right on. I would just I guess add 2 points. One is a point that he's made many times, which is basically this passive bid then is essentially tied to the labor market. Right. So labor market's going good, jobs are growing, you're going to have more inflows as people do, set up those automatic, deposits into the 401ks. But as the labor market weakens, right, that passive bid necessarily diminishes.
Right.
And so if you
It's a two-edged sword, great on the way up, but you got to acknowledge it's bad on
absolutely,
the way down. Yeah.
absolutely. So the passive bid could potentially disappear right at the wrong time, right? You go into recession that threatens corporate earnings at the same time the passive bid disappears because unemployment's rising significantly. That's a bad recipe, and I think Mike has talked about that. The other point that I would make is that it's not just passive bid. I would say that if you look at the speculative flows that we've seen into equities and other asset classes, that's way beyond what can be explained by passive only, right? You look at the money that's flowed into active ETFs, leveraged ETFs, right? Obviously, there are no 401ks, target date funds that are buying leveraged ETFs. So when you have massive record flows into leveraged ETFs, that's a sign that there's a retail bid out there that's well beyond just what's going on in passive. I'd also point out foreign flows too. Foreign flows into the equity market last year were massive new record highs. And a lot of that is kind of the same dynamic, I think, that we've seen with these Chinese retail investors in precious metals. You have South Korean investors that are buying a lot of leveraged vehicles in US equities, and a lot of just chasing the AI theme from foreign investors and domestic retail investors alike, on top of the passive bid, which has been kind of relatively steady because the labor market hasn't quite deteriorated. So I think you put those things together, and you can understand why the market has held up so well and been so strong is the passive plus a retail flow that is clearly speculative.
All right. So a couple things. This is a great vein to drill into, by the way. So my point, which I think you would agree with, but tell me if you don't, is I think the passive has helped enable that speculation, because whether it's consciously understood or not, there's a sense that there's this put to the market, right? There's this floor that passive is putting on it. So it's safe to get in the pool and be a little reckless here because you've got a backstop. Would you agree
Right.
with that?
Yeah, absolutely. I mean, the passive put is maybe a more accurate way to describe, what people have called the Fed put,
Right.
especially in the last number of years.
Right. Okay. So we got that condition. And then I was going to bring this up, but you just mentioned it. So you talked about foreign flows, which you said have been like off the charts, right? Um, you probably haven't seen this yet, but just yesterday I released a video with David Hay. So his name keeps coming up here in this discussion. And he is fascinating idea that he put out there where he said, look, those of us paying attention are worried about the potential for the giant mindless robot, right, to go into reverse, as you were just saying, right? It's been driving everything up. It could drive everything down. David is saying, I actually think there's a bigger risk than the giant mindless robot when it comes to capital flows. And I think it's foreign flows into, but potentially out of the US financial markets, because they've been going in at record levels over the past recent years, as you've mentioned. And right now, US stocks make up the largest percentage of the, basically the global portfolio as they ever have. And he's saying now all of a sudden you're starting to see emerging markets start to outperform the US markets, right? So all of a sudden there's starting to be an alternative to the US market right at the same time when the dollar continues to weaken, right? So, you get a currency benefit to investing in your own market if it's outperforming the US, right? You don't have the currency risk there that you would do with a weakening dollar. And at the same time, where the US is ruffling feathers geopolitically, and people are looking for reasons to take their money out of the US, right? I don't really like what they're doing. I don't really want to support them that much. And my opinion has been, yeah, that's just going to be a lot of hot air until the money gets better treated outside of the US than inside of it, right? So you kind of have these three things potentially happening all at once. So you could get this basically reverse tsunami of capital coming out of the US markets going to the rest of the world. So I kind of compared this to Godzilla, right? Who's going to win, the big robot or Godzilla? And you've seen some of those old, movie theater posters of Godzilla fighting the giant robots, and Godzilla usually wins.
Yeah.
So I just think it's a fascinating risk that's really not on a lot of people's radar right now, but really could be the big risk in the relatively near term over the next couple of years. And what's interesting is David noted that like South Korea, which you mentioned, they just announced a kind of capital repatriation campaign, and they said, look, if you bring your investments, home into our country, we won't tax them, right? They'll be free of taxes. So imagine if other countries start doing that, right? Right at the time where people think that, hey, maybe I'm going to get a better return in my domestic market anyways than in the States. That could be a huge game changer that I mean, besides David mentioning that, I hadn't really heard anybody talk about that before.
Yeah. Well, foreign flows are one of those indicators. You look at, they are very cyclical, and are maybe like we were saying, the passive bit is kind of the underlying thing, but the foreign flows are really the fluctuation that drive the difference between bull and bear markets. And I think I've even seen studies that show that the PE ratio in the S&P 500 is more driven by passive flows than anything. And so, when you see these massive inflows
Sorry, passive flows or foreign flows?
I'm sorry, foreign flows. Exactly.
Okay.
Thank you. The foreign flows, peaked back during the dot-com bubble in 2000, rolled over just at the same time as the dot-com bubble began to burst and went into a massive bear market. It's really a good real-time indicator of where you are in the cycle. And so the huge inflows that we've seen by foreign flows, are on their own, I think, a good signal of where we are in terms of the cycle. And I would just point out too, we don't even need to see outflows to affect stock prices. If it required such massive inflows, exactly, for the markets to do what they've done over the last year, then just the marginal buyer just kind of saying, okay, well, we're just not going to buy any more. Would be enough to kind of create some relative weakness compared to what we've seen in the recent years. I would just say too that Dave and I talk about markets a lot, and one of the main themes that I've kind of highlighted is the trend in the dollar, because the trend in the dollar is probably the best indicator of whether you want to own real assets or financial assets. And so dollar bull markets are usually coincide with bull markets and financial assets. So bonds and stocks do well when the dollar's doing well. And that's usually like money's flowing into stocks and bonds, and so the dollar goes up. It's kind of a chicken or the egg thing. But when the dollar does poorly, is that a driver of money out of dollar-based assets, or is it the fact that stocks and bonds start doing poorly, and so it drives the dollar down as money starts to come out? The dollar recently got as overvalued as it's ever been, and it's a really good, that valuation, whether you're looking at real effective exchange rate or purchasing power parity, whatever kind of indicator you want to look at, is a really good indicator of the next 10 years trend in the dollar. The dollar's on the verge of breaking down out of a major uptrend channel right now. If it does convincingly, that's another clear sign that I think we are in a longer-term bear market for the dollar, which is as clear a signal as you'd want to have, that you need to favor real assets over financial assets. And so stocks and bonds, dollar-denominated stocks and bonds are things you're going to want to underweight, and you're going to want to overweight real assets, commodities, the precious metals, et cetera. As I said, within the commodity space, it's more attractive to focus on some of the more undervalued commodities right now. But I think that trend in the dollar is really key. Whether it's the cause of people to reduce investments in dollar-based assets, or it's the fact that dollar-based assets just ran too far too fast, and now they're in for a prolonged period of below rate returns. As you said, January was the worst relative return for the S&P 500 relative to the rest of the world in 20 years, I think. And January was pretty good in the S&P 500. So there's the big incentive out there for money to start flowing back. Aside from all the political stuff that's going on, there are economic reasons for money to flow back home to South Korea, to Japan, and that dynamic could last for a long period of time.
All right. Well, look, we'll be definitely keeping our eye closely on this going forward. All right, so let's get into commodities. I know you think the whole complex is set to have I think you said a 5-year bull market or so ahead of us. Um, I want to dig into where you see capital going next, but let's stay with the precious metals just for a moment. Like you and David, in recent weeks, as all viewers of this channel know, I was ringing the warning bell about vertical price moves don't last, and they don't
Yeah,
end by going sideways, right? And
right.
we've got two very pronounced similar price action charts with gold and silver, where we had a massive vertical spike like this, and then it got pretty ugly, right? I
Yeah,
mean, the prices collapsed, it gave up almost all of the spike, and then the metals were kind of dead money for a decade or more.
yeah,
Um, the warning was just, hey, folks, it looks uncomfortably, um, uh, odds look uncomfortably high that you're going to see some sort of material violent pullback soon. A lot of debate on how to prepare for that. Um, the big question now is, okay, so we've had a pullback. Is this the start of a complete collapse in the gains that these metals have had, just like in those two prior peaks? Or is it different this time? Will they find footing, and will they eventually potentially go off to higher highs as this 5-year bull market in real assets continues? Do you have a strong opinion one way or the other on that?
I do not think this is a 1980 type of top for the precious metals. I think that it's difficult to have a sustained bull market for commodities without the precious metals participating to some degree. I will say, though, that they did go, way too far too fast. And that, the corrective action, the way the precious metals work is kind of inverse from the stock market, right? They kind of like, I think, Tom McClellan has talked about this, how stocks, bottoms are kind of a point in time and tops are a process.
Hmm.
Well, the reverse holds true for the precious metals,
That's
where
true.
tops are a point in time and bottoms are a process. It's kind of the inverse of the stock market. So I do think the bottom in precious metals, again, just like it was, in 2015, 16, just like the bottom was after the top in 2020, 2021, you had a period of kind of corrective action that lasted for a couple of years. I think that's probably what the precious metals are doing right now, is you see these big spikes, and then they kind of just go through a corrective period for a period of time, and you go through a long bottoming phase that's long enough for people to forget about them. And I think that's when they get interesting again. And so I think that what will happen now is we'll see precious metals go through another corrective phase that will kind of be a more longer rounding bottom thing, just like we see usually takes a couple of years as the rest of the commodities complex catches up, and because we need some time for the rest of the space to play catch up.
Okay. Might not be what folks here want to hear, but uh, you know, better than, hey, it's another 1980 or 2011 where it just collapses and then does nothing for 15 years.
Yeah.
Um, okay. So I guess you've talked a little bit about it, but maybe just clarify a little bit more your general thesis for why you expect commodities in general, hard assets in general, to do well going forward. Is it really just a story about the dollar?
It's a story about the dollar. It's also a story about, I really think it's a story of the capital cycle. That I think longer term, the capital cycle is the main driver of returns in all asset classes. There's a book behind me, Capital Returns, is a good, kind of primer on how this works. But essentially, it's follow the money. Whenever a ton of money flows into a sector, you naturally get overinvestment that creates oversupply and terrible price performance going forward. We saw this, right? In the wake of the financial crisis, interest rates came way down. Money got really cheap, and a lot of that money went into the commodity space, because what was booming from 2000 to 2011 was commodities, was the oil price when we did really, really well. And so you had overinvestment in oil. The oil price crashes in 2014, 15, 16, and returns were terrible for a decade for energy investors. all the capital today, where's it going? It's going into AI. And so we have an overinvestment, oversupply in compute right now. It's going to lead to terrible returns going forward for a period of time in the AI space.
Sorry to interrupt. So totally agree. You've talked a lot about this. I just want to add in here from a valuation standpoint, right? We're seeing valuations at levels historically extreme or record historically, which to your point, generally precedes a decade or more of poor performance because you pulled all of tomorrow's value into today.
Oh, absolutely. Yeah. And the valuations are driven by that overinvestment, right?
Right, so exactly. Yeah.
So much money flowing into the AI space right now that it just drives massive overinvestment, overvaluation. And that, that results in terrible oversupply, which pricing collapses and you have a decade, a lost decade. I think if you look back, where has what areas of the world of the economy have been starved for capital for the past decade? You go look back to the energy space, look back to just natural resources investment in copper mining, in a lot of these types of things, in oil and gas investment. And that moves in very long-term cycles too. So we had all this massive investment. US became the largest producer in the world. But now the Permian Basin and a lot of the rest of the oil production in the United States is plateauing and rolling over. At the same time, demand continues to grow. We haven't found any new resources, any new oil resources. At the same time, we're cutting back on investing in green energy. We're cutting back on people buying EVs. And so the demand for fossil fuels is actually going to have to be revised higher because a lot of this investment in alternative energy sources is faltering. So, I think that from the capital cycle standpoint, energy has been massively underinvested for a decade now, which is going to make supply tight going forward. I mean, right now it looks like there's talk of a major oversupply this year, but even energy bears concede that 3 years from now, 5 years from now, we're going to be at potentially massive deficits in terms of supplies of oils and things if demand continues to grow. And we have no more new supplies coming online. So I think, to just come back to the capital cycle is very important, kind of big picture thing for investors to kind of keep an eye on. What's going to do well over the next 10 years is partly a dollar story. Is the dollar's overvalued? It's going to come down. Real assets should benefit. But at the same time, capital, for these companies has been highly restricted, meaning that supplies are going to be constrained for the foreseeable future.
Okay. I'd love to keep picking your brain on oil and gas, but I did very recently do an hour-plus long drill down on exactly this industry with Rick Rule. And so folks, if you really want to get a deep dive in that, go watch that video with Rick. I think it was about a week ago. Rick also kindly goes through a bunch of specific companies that are on his watch list. So if you're looking for potential companies to invest in to play this, that'll give you something to consider. One thing that Rick said, Jesse, that I'm going to guess you agree with is what's kind of especially attractive about the opportunity in oil and gas right now is, yes, it has the potential to enter back into boom. It's a boom bust industry. It's famous for being such. It's been in bust for a long time. So hopefully the boom is ahead of us. And if you get in now, you get in at better valuations and you can ride the boom. But most of these companies, the larger ones, pay really attractive dividends. And so you get paid to wait. Right. Which a lot of times, especially in the hard asset space, you don't, right? A lot of these companies, generally, are kind of cash flow challenged during the bust years. And so, like Rick was talking about, like with uranium is a good example. He saw that opportunity coming. He recommended it several years before it caught fire. And he said, while I was waiting, I just had to eat the opportunity cost of that capital. Whereas in the oil and gas space, they kind of cover it for me.
Right. Yeah, I mean, you get paid a dividend. I would also point out too, like everybody thinks the sector's so depressed just because the returns relative to the broad market they've basically gone sideways. Energy has really started to do well again this year. But really since 2020, energy is the single best performing sector in the S&P 500. Since 2020.
Since 2020, what? Really?
Since 2020, right? It's the single best performing sector. It is by far the best performing sector year to date in 2025. And there was an article this morning in the Wall Street Journal, that analyst saying, I literally have not had one portfolio manager ask me about the energy sector. Nobody wants to own it, but it's literally the best performing sector for the last 5.5 years.
That's crazy.
And it's performing, it's because the last 2 years have been, oil peaked a couple of years ago and has been coming straight down for 3 years. But I come back to that, I mentioned this a minute ago. Meb Faber has shown a really interesting statistic. I used this kind of for my bull case in gold back in 2015. When any asset class declines 2 years in a row or 3 years in a row, it usually is a really good sign sentiments become too bearish, and returns statistically are very good over the following few years. So oil's down. If you just look at USO ETF, it's down 3 years in a row through last year. So that's a sign, that's why, people are so bearish on the group. And it suggests that it's primed for some much better returns in the next couple of years.
Well, I'm doing this from memory, so if you have better numbers, please correct me. I think it was Rick who was saying, definitely in past decades, but maybe this was an average of the past number of decades or whatever. I can't remember what percentage of is it percent of the S&P? Percent of the S&P or percent of people's portfolios, but oil was represented like 20%,
right?
And it's now like 3%.
Yeah, it was literally as a sector relative percentage of the S&P 500, it got to like 2.5% last year. Nothing, and it's historically gotten up to 10-15%.
And it's the thing that the world still runs on.
Yes, yeah, absolutely. And demand, I mean, there's no sign that global demand is diminishing anytime soon. Demand continues to hit record highs, and we have no more new supplies coming online. Literally, U.S. production, I think, when you start to understand the dynamics of the potential supply constraints we're going to see, you start to understand what's going on in Venezuela. These types of things are happening because the cash cow that has been U.S. oil production for the last 20 years is potentially peaked and roll over. I mean, U.S. production has potentially peaked and is now rolling over. And so, if that's the case,
at least at these prices.
No, I would say generally, and the thing is, and Rick probably talked about this, but that all of these frackers have high graded all their production. So they drilled all of the easiest wells first. Right. So now all the rest is tighter and tighter oil, more difficult to drill and more. And so to bring supply online now is much, much more difficult than it was 3 years ago, 5 years ago, because all of the easy wells have been drilled. All the most attractive fracking has been done. And so if demand continues to grow, it's going to be very difficult to meet that with the supplies that we currently have. And because production has certainly plateaued, is potentially going into decline.
Yeah, so I agree with everything you're saying. The reason why I chimed in there about current prices is, we're at the point. You probably saw the articles. Was it Harold Hamm? Is that the guy's name? Who's been a driller in the Permian, or I can't remember which basin.
He had Continental Resources. Yeah, he was one of the big insiders who was buying back in 2020, buying shares of CLR, was the stock back then. The stock like tripled, and then he took it private. So yeah, he's one of the smartest guys in the space.
Yeah, and apparently, I mean, he's been in the space for decades, and has said he's never not had an active drill rig. And he just basically took his last active rig offline. And that's because, to your point, in the shale basins, we've just hit the point oil price wise where it's just not economical to do the extra work that you're talking about, right? Yeah. It's becoming more expensive to extract
exactly,
and below a certain price you don't. So, it's interesting, and I don't want to give a huge lesson here on it, but there's conventional oil, right, which sort of peaks in a bell peak, right? If you've heard of like peak oil. But these shale wells that it's been a magnificent bounty for America that we sort of discovered how to tap efficiently. They drain asymptotically, right? And so, you get the majority of the barrels out of them in the first couple of years, and then it's a very long, small tail after that, or it's a very small tail after that. And to your point, humans being humans, you go after the easiest stuff first, the most profitable stuff. So we've high graded it, right? There probably still is a fair amount of oil there that we can go after and extract to increase production, but it's going to have to come at a substantially higher oil price because those wells aren't economic to drill right now. Um, that being said, at some point in time, these basins will be played out. I have no idea when that's going to be. I'm not a geologist. I don't know, but I do know that, to your point, unless oil prices go higher here, they're just going to continue to just stop going for it. And we've seen that on the more conventional side as well, where a lot of the oil companies, this is Rick's whole point, is oil prices have been driven down, so less incentive, economic incentive to go out and explore and develop. But also until recently, the regulatory environment was so antagonistic that these companies were like, well, I'm not even going
Right.
to go out exploring because
Yeah.
it feels like the government's trying to put me out of business in 5 or 10 years, right?
Right.
So that's changing a little bit, but oil prices are still so low that it seems like the companies aren't really willing to open the purse strings yet. And even if they were, well, you're not going to see the results of that for many years down the road. So, there's a lot of reasons, like you're saying, that there's good reason to anticipate real tightness in supply going forward, which obviously is met then by higher prices.
Absolutely. And I think, I would just come back to, I think the CEO of Saudi Aramco, has been talking about this a lot, saying we've literally just spent more than a decade with zero exploration and production in the energy space.
Jeez,
There's going to
jeez.
be consequences for
Yeah.
that. If you literally, and that's the oil price crashed, as I said, in 2014, 15. And since then, there's been literally no new exploration for oil. And so, I refer a lot to the work of Gehring and Rosenzweig, and Lee Gehring has probably done some of the best work in this space. And he shows that every one of these major cycles in prices is driven by new finds.
Hmm.
And so you have a new find, it drives prices down, and then you don't explore for a while because prices are down. And then you get tight supplies, prices boom again. And so then exploration happens and you can find, oh, okay, we found this new big oil thing. And so, it was the North Sea oil for a while. And then it was now the last cycle was discovering the fracking technology that drove another big boom in production. But we're not going to get another big boom in production like that without oil prices literally at least doubling, if not tripling, off of their current levels.
Okay. And for folks who are saying, yeah, but Jesse, we just, got control of Venezuela's oil, and isn't that going to bring a ton of oil onto the market? Folks I've talked to have said, maybe, but if it does, it's going to take a decade plus. It's not something that's going to happen anytime soon.
Well, in the investment, you can't just shutter the production and then just flip it back on with a switch. It takes so much work and engineering, and a lot of the companies that are able to do that work to bring that production online, as you said, it'll take years. But the risks, the political risks of going back into Venezuela after they've already been privatized a couple different times and had all of their investments taken away from them is too great. So the potential returns have to be massive for companies to want to even invest at all in bringing Venezuelan production back online. And even if they do, it takes years. And so, yeah, it's going to take much, much higher oil prices to even make that possible.
Okay. And then the last question on this, if you have an opinion, to somebody who says, well, let's cross our fingers and hopefully the war in Ukraine ends and then Russia oil isn't embargoed anymore. And then maybe there's a friendly regime change in Iran, and we do lift the sanctions there. Is there a chance for geopolitics to change the game here and supply the cheaper oil the world would need in the next 5 years before these new discoveries come online?
We're pretty much using. I think China is now building a surplus or a strategic reserve. We're trying to rebuild our strategic reserve, which has been, was essentially emptied to the greatest extent that it's ever been emptied. And so I think that, are we more susceptible to, is the oil price more susceptible to political risks that drive it higher or drive it lower? I would say it's clearly skewed toward prices driving it higher. The Strategic Petroleum Reserve here in the US is still at the lowest levels it's been in decades, right? And oil supplies outside of that, right? Just commercial supplies are running at their lowest levels and 5-year average kind of levels too. So I would say that the risk is much more to higher oil prices from any potential political developments, just because of those very low inventories in terms of, like, I mean, imagine if we have another oil price spike today for whatever political reason, and there's no oil in the Strategic Petroleum Reserve to be released to meet it. I mean, that's where we're at right now. And I don't think a lot of people appreciate that. People are behaving as if, oh, well, we can just, handle any type of spike, by increasing production or releasing from the reserve. We can't increase production anymore. The U.S. production is plateaued and potentially rolling over, and the SPR is empty. So, I mean, the risk is clearly to the other side of the ledger, I think.
Okay. I want to just jump back to the precious metals for a second, and then we'll get to a few other commodities that you like. On the precious metal side, there's the metals, which I think you've said, hey, they could have a prolonged period here now of recovery, and there's the miners. And I just want to mention Rick Rule again. He caught a lot of folks' attention a few weeks back when, on the way up, he sold 80% of his physical silver at $75 an ounce, and shifted half the proceeds into silver miners, and basically said, hey, look, I think the metals are moving probably too far, too fast. I'm not going to be greedy. I'm going to take my gains off the table. The miners haven't moved, though, in their leverage way they normally have. And, even though up until last Friday, the price was going higher and higher, Rick was like, look, if the prices comes down and just kind of hangs out around $75 an ounce, I think these miners have to dramatically reprice higher, because they're just going to have such great profit growth from the higher metal price. Do you have an opinion as to, even though the metals have just been kind of monkey hammered here, do the miners still look attractive to you, or would you not touch them until the metals start showing signs of life again?
Yeah, I really use them as a trading vehicle to trade the metals, and so until I get bullish on the metals themselves again, I don't have a ton of interest in increasing stakes in any of the miners. I will say, one of the main things that I think will keep a relative bid underneath the precious metals, keep them from being a 1980 type of event, is the prospect of a debt crisis, right? This is the big difference between today and 1980. In 1980, debt levels were tiny. The deficit was tiny compared to where we are today. And the money printing that the Fed is being forced to do in order to support the massive amount of debt issuance that we have to do, right? I mean, for the Fed to go back to expanding the balance sheet at a time when inflation is still above target is a clear sign that we are in and have been in an era of fiscal dominance for quite some time now, where the Fed can only shrink its balance sheet to the extent that it starts to create problems in the money markets, problem in the treasury market, and then they're forced back into expanding the balance sheet, which is essentially money printing. One thing that I'm paying close attention to, and Robin Brooks has pointed out, is that we are probably already in an age of rolling financial sovereign debt crises. Right? We had the Liz Truss kind of moment for the UK. Japanese yields have been soaring and the yen is super weak, right? We're starting to see this with dollar weakness at the same time as the 30-year Treasury yield is starting to push back up towards 5%. This is something to keep a very, very close eye on. That if the 30-year Treasury yield does break back above 5% and the dollar breaks down out of this uptrend that it's been in for 15 years, it's a clear sign that this rolling debt crisis has come to the U.S. So that's something I'm paying really close attention to, and I think that the risks involved with rolling sovereign debt crises around the world, are going to keep a bid underneath the precious metals, and that will really be what separates, what makes this not another 1980 like a support for real assets for the next several years at least, is until there's some kind of fiscal resolve to deal with what's driving these rolling sovereign debt crises, you're going to have a secular bull market in the things that are limited in supply, commodities, precious metals, et cetera. So while I'm not tactically kind of bullish on the precious metals just yet, I do think as part of this bigger theme, they will maintain certain price levels. I just am more bullish on some of the more undervalued commodities right now. But this idea of a rolling sovereign debt crisis is really part of one of the main themes that goes along with a lot of this other stuff.
Okay. Big macro theme again, something we'll be watching really closely as time goes on here. You were talking earlier in regards to the dollar about a weaker dollar versus other currencies. You hadn't really talked that much until I think just now about just sort of inflation,
Right.
about the dollar versus real things. I don't want to put words in your mouth, but are you sort of expecting an inflationary era ahead here?
Absolutely. I think that that is the message from gold and commodities. Is gold is basically saying that inflation is not dead, and the Federal Reserve's resolve to bring it back to 2% is not what markets would like to see. Right, copper price breaking out to new highs. The commodities complex has been really strong over the last few weeks, and interest rates typically and inflation typically follow the commodities. Weaker dollar is part of that too. So yeah, all of those things right now are pointing towards a resurgence in inflation. Right, the PPI numbers that we saw last week suggest that the PCE is still running way above the Fed's target. Median CPI still well above probably 4% ish, and so there is no resolve at the Federal Reserve to really bring inflation back down to target. That's what these markets are saying.
Okay. All right. So back to the commodity complex. We've talked about precious metals. We've talked about oil, not so much gas yet. But what other commodities are kind of at the forefront of your radar right now that you're most interested in?
It's really the broader commodities complex, relative to the precious metals. When I look at them as gold is a leading indicator for the rest of the complex, it leads by, I don't know, a year and a half, different commodities. But when I look at it, the oil prices specifically, and sorry to keep coming back to this, but it's the oil price has lagged the broad commodities complex to a greater degree than I think we've ever seen. As I said, the oil price relative to gold has only ever been as cheap as it is today when oil price went negative back in 2020.
Yep.
So literally, it's so cheap. Oil price is so cheap relative to the broad commodities complex and relative to the precious metals that something has to change. Either precious metals prices have to come way down even further to kind of bring this relationship back to some sense of normalcy, or the oil price really has to start to take off in a major way. And it's showing signs that it's potentially ready to break out. I don't know what the catalyst would be. It's probably just revising, some of the EIA, kind of estimates, IEA estimates higher in terms of demand, because they've been underestimating demand for years, and so revising those estimates higher could be one of the potential catalysts, but it also could be, political things, obviously, with everything going on in the world. So to me, it's energy is the main one that I'm focused on.
All right. And when you say energy, is it pretty much all oil, or do you have gas, uranium, coal, other stuff in your watch list, or is it
No,
mostly
it's
oil?
all oil and gas producers. Last year, I wrote a couple of pieces about the actually offshore drillers that got so cheap, those stocks, Noble Energy, Tidewater, Helmerich and Payne. These stocks got so cheap last year that they almost had to bottom and reverse higher. They've performed really well over the last 6 months or so, but probably still aren't close to kind of fair value. And offshore is one of those areas where, yeah, production has kind of just gone away because of the oil price. And so if it's going to take much higher oil prices for the offshore stuff to really start doing well. But that's where a lot of the insider buying was last year, was in offshore. And it's very, very curious because it does require probably some, significantly higher oil prices for it to make sense.
Mm-hmm. Okay, so if you're comfortable sharing, are you mostly playing this by owning individual producers, individual companies there versus, say, an oil industry ETF?
Yeah, as for an ETF, I think the one that still shows kind of relative value, a lot of, the oil and gas service and equipment companies have kind of done well lately, but the oil and gas producers themselves are still kind of lagging. And I think that's a function of the bearishness towards the commodity itself still. And so, XOP is an ETF of just the oil and gas producers. I like it because it's more diversified too. It's also not super just heavily into Exxon and Chevron. It's pretty well diversified among a number of different producers. But, I just point out too that I think Occidental Petroleum, for example, is still trading at a price like right around Warren Buffett's average cost basis. So, for almost any other stock in the Berkshire portfolio, if you said you can buy it at Buffett's cost basis, people would be jumping all over it. Yep. But as soon as you say it's Occidental Petroleum, people say, oh, well, it's energy. And yeah, I don't want to own that. And to me, that's about as bullish a sentiment sign as you could hope to see.
I was going to say that's where you see the opportunity, right? Is sort of, you think the market's mispricing, right? It's
right.
It has thrown the baby out with the bathwater. Yeah, time to put the babies on the cheap. Okay, so I mentioned in the intro one of the indicators that we've talked an awful lot about when you've been on this program in the past, which was the insider sell to buy ratio. And I mean, it seems like every time you come on this program, you're like, oh my gosh, that's at an even higher percentage than it was before. Where is it now?
It's actually started to roll over and get a little more bullish. And I will say that it leads by about 18 months. So, and I've said this, I think, every time, is that the insider selling that we saw in 2024 and into the first half of 2025 was like nothing I've seen in my data set. It's literally like off the chart. And that sell to buy ratio hit record highs. Whether you're looking at a 12-month look back period or a 22-year look back period, you hit record highs in the sell to buy ratio. It's come down as a function of two things. One is, Elon made $1 billion purchase of Tesla shares last year, I think as a tried way to influence people to vote for his new pay package. So you could say that was maybe kind of a performative purchase, but I'm not adjusting, my numbers for that.
And it was so big that it impacted the entire data set?
Yeah, I mean, over a 12-month period, if you get, $7-8 billion worth of buying, that's a lot. So 1 billion in one transaction by Elon skews kind of the numbers in one direction. But I'd also say too that selling has dropped off. We're not seeing the amount of selling that we saw last year, and a lot of that is also just like, look, Oracle's down 50%, Palantir's down 30-40%. Palantir was one of the big sellers. NVIDIA has gone nowhere. NVIDIA sellers were big last year. And so I think you're starting to see some of the selling dry up, which brings the ratio down. But my big point is that it leads by 18 months. And so that massive selling that we saw over the last couple of years really suggests now, that's as a group, that's corporate American insiders, CEOs, CFOs saying that right now, essentially in the first half of this year, we should start to see some real economic deterioration, some real earnings start to be this, reflect in earnings disappointment over the next couple of quarters. And so, we're right kind of in that danger zone. And so what you would want to see before kind of the insiders start getting you bullish is that ratio come down to, 10 times, sell to buy ratio, and be there for a period of time, because then that says 18 months from then, you're going to start to see some real, more bullish dynamics in the economy and things. So we haven't gotten to that bullish reading yet in the numbers, and even that would be kind of an early signal. So I think right now we're right in that time frame, that window where insiders have forecast for economic and earnings weakness in the next couple of quarters. So it'll be interesting to see if it materializes, because it's been really, really accurate. Probably one of the best leading indicators that I have in my arsenal.
Okay. So as we start to wrap up here, your overall market outlook for 2026, is it more bullish? Is it more bearish? I will just note that we've had 3 successive years of 20+% returns on the market, which in and of itself is statistically rare.
Yeah.
So to expect a 4th one, you're pushing the statistics. Of course, doesn't mean it couldn't happen.
Yeah.
But I'm curious, with that lag with the sellers and everything, if you're more net bullish or bearish. You're definitely bullish commodities.
Yeah. No, one other thing I'd point out too is that margin debt, the surge in margin debt that we've seen over the last 18 months, 2 years has been huge. You've seen like a 30% increase in margin debt. That's usually a good leading indicator that you're in for a deleveraging event. So you have that kind of compare along the insiders saying earnings could disappoint over this next several quarters. At the same time, the speculative juices, the amount of leverage that we saw put on in margin debt over the last 2 years also suggests that we could see a deleveraging event sometime this year. I think you put those together, and it paints a pretty bearish picture of earnings disappointments, and then magnified by some sort of deleveraging, among investors. Margin debt is at absolute record highs, whether not just in nominal terms, but margin debt to GDP is higher than it was in 2021 at the peak, and significantly higher than it was in 2000. But it's also that rate of change. So the amount of leverage the investors have put on in the last couple of years suggests that it's gone way too far. It's very similar to the message that we saw in gold and silver.
Mm-hmm.
And that's why I was saying that, like a lot of this rising volatility that we're seeing in precious metals, in Bitcoin, in, a lot of these different things. And one other sector that I would point out is there are some signs in the credit markets that things are not healthy, right? We had the sudden bankruptcy of First Brands, which is now, being brought up on fraud. BlackRock just disclosed that at their business development company, they wrote down the asset value in that fund by 19% overnight.
Mm-hmm.
And so just pull up a chart of, BizD, and you'll see that business development companies are saying there's something not healthy in the credit markets. Same time, leveraged loans are starting to roll over now. Leveraged loan prices. Leveraged loans are now actually a bigger market than the high yield market, than the junk bond market. So
Really?
the fact that leveraged loans are starting to roll over in terms of price too. We hit the highest level of Chapter 11 bankruptcies in the third quarter last year that we've seen since 2011. So credit markets are starting, and it's obviously it centers in AI, right? You see Oracle, CDS, these types of things. Blue Owl, which is Meta's biggest partner, private capital partner in funding. The Blue Owl shares hit a new 52-week low today. So there's signs, if you look for them, that the credit markets are not healthy and they're potentially deteriorating. And that's something I would pay very close attention to too, because if business development companies are starting to write down stuff, we're starting to see more cockroaches, as Jamie Dimon recently said we might, then that plays into this theme of earnings disappointments and kind of a turn in the cycle. Rising unemployment, as we talked about, could be bad for the passive bid. I think all of those things paint a pretty nasty potential picture for stock prices this year.
All right. So in terms of how investors should consider playing this year, I'm hearing sort of a mixed message, or not a mixed message, but I'm hearing different components. I'm hearing maybe play offense when it comes to hard assets, particularly oil, but probably play defense, certainly with the markets in general. So what does this look sort of like a barbell type of position here?
Yeah. Well, usually, when energy does well, it means inflation's going up, interest rates go up, bad for the rest of the stock market, which is why, energy can actually work as sometimes a hedge. You look at 2022, right? We had a bear market in the S&P 500, the NASDAQ, and energy had a terrific year. And so yeah, I don't think it's inconsistent to say, let's, be bullish on energy and be bearish on the rest of the stock market, because that's typically, that's how it's worked in recent history, and probably will work going forward. Is real assets will benefit to the extent that financial money comes out of financial assets. And so, I think inflation could surprise to the upside, earnings surprise to the downside. And it's not hard to kind of think of, how do I want to be positioned in that environment? I don't want to own long-term bonds. I don't want to own too many stocks. Want to have, basically do what Warren Buffett is doing. It's large cash position. I think it's very interesting that, people were saying, oh, well, he was raising cash because he wanted to set up his successor for, to do what he wanted to do. Well, Greg Abel's now taking over, and he's selling down the Heinz stake, even raising more cash. So, so I think, cash is king right now, and you're still getting paid 3.5% risk-free on your cash. And there's a lot of optionality there to take advantage of things, weakness and other asset prices. If the volatility, as I said, in precious metals and cryptocurrency starts to creep into the rest of the asset markets.
All right, and I am wrapping things up here, but since you mentioned it, Bitcoin. Bitcoin has been underperforming relative to the precious metals, and while it didn't get as eviscerated as they did on Friday, it still dropped fairly notably over the past couple of days. I think it's trading in the mid 70s-ish right about now. So any particular thoughts on Bitcoin's direction from here?
Well, it saw over the summer a real similar dynamic. I think it kind of led the precious metals, where you had all of these Bitcoin treasury companies kind of copying the Michael Saylor model. We're all going to, sell debt or sell equity and use it to buy crypto. And that kind of
You're getting like a 25% stock price pop on the announcement. Yeah.
Exactly. And that type of speculative euphoria really kind of marked the top for that group. Now, you have all these companies that are highly leveraged to crypto, right? MicroStrategy, Strategy is the new company name, is kind of the poster child for this. And their cost basis is, I think, 76,000 on Bitcoin. So if you get Bitcoin weakness, Saylor has said he's raised, it's interesting, he's raised a bunch of cash, right, and not put it into Bitcoin. So I think that's pretty telling right there, that, to meet debt payments and things, the company that says don't hold cash is now holding cash. And if cryptocurrency continues to go down, they could be forced to go from an accumulator to a liquidator. And I think we're probably headed in that direction.
Would that be like a nuclear event for two reasons? One, because they hold so much Bitcoin, they'd be, potentially flooding the market with it, but also just the signal that the most religious uber bull on the asset all of a sudden is, maybe he's being forced to, maybe he's doing it against his preferences, but he's doing it.
Right. Yeah, that would be very telling. I think it already is very, very telling for the one guy to say, never sell your Bitcoin and never hold cash, to, be doing just exactly what he's, the opposite of what he's been preaching, is building up a cash position in order to meet debt, debt payments, and dividend payments and things. And so I think, it would be very telling if it were to go into reverse, and sadly, I think that's probably where it's headed.
Okay. Last question, just to slip in, I'll just take a one-sentence answer, but back to the precious metals for a second. Do you see them hitting new highs by the time this 5-year bull market in hard assets is over?
Oh, yeah. Yeah, I think, by the time it's over, as Lee Gehring has pointed out, we've seen the Dow and gold at parity several times in the past. And I think that wouldn't be unsurprising again to see the Dow Jones Industrial Average and the gold price at parity at some point in the future. How we get there is anybody's guess, but I think that wouldn't be unsurprising to me at all.
All right, let me just note at the time that we are recording here, the Dow is at 49,500, gold is at 4,700. So gold would have to go up by an awful lot, or the Dow would have to come down by an awful lot.
And it's probably some combination of both.
Yeah. All right, Jesse, thank you. It's always just so easy and informative and a pleasure to interview you. Thank you again for coming on. Most important question for folks who would like to follow you and your work in between now and the next time you come back on this channel, where should they go?
Well, my website is thefelderreport.com. I publish a free weekly blog post there highlighting typically 5 things that I found during the week, the 5 most interesting things. It could be a research report, a chart, a quote, and put that out every Saturday morning. Also write a weekly market comment for premium subscribers and publish specific trade ideas for pro subscribers, individual stocks where there's compelling insider buying. Yeah, thefelderreport.com.
All right. And as usual, when I edit this, Jesse, I'll put up the link to your website there on the screen so folks know exactly where to go. Folks, the links will be in the description below this video as well, so you can get there with one click. All right. Well, in wrapping up here, folks, please show your appreciation for Jesse coming on and just delivering everything on the whole table the way he always does. Please let him know your thanks by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. 2 quick notes. One, obviously, if you would like to take some action based upon any of Jesse's ideas here, and you'd like to get the help of a good professional financial advisor in doing so, if you don't already have one who's advising you, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. As a reminder, these consultations are totally free. Only takes you a couple seconds to fill out that form. There's no commitments involved. This is just a service these firms offer to be as helpful to as many people as possible. Secondly, we are officially announcing the Thoughtful Money Spring Online Conference. It's going to take place on Saturday, March 21st. Don't worry if you can't watch live. Everybody who registers will be sent replay videos of the entire event, all the presentations, all the live Q&As. Immediately afterwards, we're getting pretty good at sending those things out just a few hours after the event concludes. And as I've said, we have the absolute best faculty that we've ever had. I'm doing this from memory, so I'm not going to be able to hit everybody, but we've got Lacey Hunt kicking it off with his amazing keynote as always. We'll have Ed Dowd joining us this year. We've got Matt Taibbi joining us this year. We've got Mr. Liquidity himself, Michael Howell. We've got Darius Dale. We've got Luke Groman. We've got Brent Johnson. We've got Judy Shelton, Daniel DiMartino Booth, Grant Williams, Stephanie Pomboy, David Hay, who we've talked about here, Melody Wright, Andy Scheckman. Gosh, I know there's 1 or 2 others there. I'll just mention them. You'll hear me mention this again. But anyways, you can find out all the details by going to thoughtfulmoney.com/conference. And if you go now, you'll be able to buy tickets at the early bird price, which is the lowest price that we offer. We want as many people to get that lowest price as possible. And if you are a premium subscriber to the Thoughtful Money Substack, you'll get an additional $50 off that low early bird price. And so if you are a premium subscriber, look at your email inbox. I sent you an email out yesterday that's got the discount code that you should use. All right. Well, look, folks, it's always a complete pleasure and joy to interview Mr. Felder. Jesse, can't thank you enough. It's always such a pleasure, my friend.
Thanks for having me, Adam. I always enjoy doing this.
Thanks. All right. And everybody else, thanks so much for watching.